Welcome back. So today, we're going to tackle a big one. A question that honestly confuses just about everyone when they first start out. Why on earth do share prices go up and down so much? You know, it can feel totally random, but I promise there's a surprisingly simple logic hiding under the surface, so let's dive in.
Okay, so before we can really get into why prices change, we've got to make sure we're all on the same page. Let's do a super quick recap of what we've already covered.
All right, first up, we know what shares are, right? They're just a tiny piece of ownership in a company, like owning a single brick in a giant building.
And second, we know that people buy and sell all these little bricks in a huge marketplace called the stock market. Simple enough.
Okay, so that recap brings us right to the heart of today's puzzle.
I mean, think about it. If it's the exact same share from the exact same company, why does the price keep changing literally every single day? It was one price yesterday, it's another today. What's going on? Well, that is exactly what we're going to figure out.
And here's the good news. The answer isn't some crazy, complicated financial formula that you need a PhD to understand. Nope, it's actually a concept that you already see in action all the time in your everyday life. It all boils down to just two fundamental forces, demand and supply. Seriously, that's it. This constant push and pull is what sets the price for, well, for everything, from a loaf of bread to a share in a huge company.
And this is a really important point to get. The price of a share isn't some number the company just decides on. Not at all. A price is really just an agreement. It's that magic number where a buyer and a seller meet in the middle. It's the point where one person says, I'm willing to pay this much, and another person says, okay, I'm willing to sell for that much. Boom, that's the price.
So let's look at how this plays out. On one side, you've got a situation where there are way more buyers than sellers. Everybody wants to get their hands on this share, right? That's high demand. And when you've got lots of people competing to buy something, they start offering a little bit more to make sure they get it. The result? The price goes up. Now on the other side, what if more people want to sell the share than buy it? Well, now the sellers are competing. They have to start lowering their price to attract one of the few buyers out there. The result? The price goes down. It's this beautiful, simple balancing act.
Okay, to really make this stick, let's use an analogy that I'm sure we've all experienced. Imagine your favorite band is coming to town for one night only, and the show is almost completely sold out.
So what happens in that situation? First, you have tons of fans all scrambling to buy tickets. That's super high demand. But there are only a handful of tickets left. That's a really low supply. The result? The price for those last few tickets absolutely skyrockets, right? That's demand and supply in action, pushing the price up.
All right, now let's look at the complete opposite. Imagine you're at a clothing store, but it's the very end of the season. Think the clearance rack. Okay, so the store has a whole bunch of items left to sell. That's a high supply, but hardly anyone is looking to buy them anymore. That's low demand. So what does the store have to do? They slash the prices. They put everything on sale to get it sold. See? It's the exact same principle, just in reverse. Low demand pulls the price down. Okay, so this is great. We get it. Supply and demand drive the price. But that leads to the next big question, doesn't it? What makes demand and supply change in the first place? Why do a bunch of people suddenly decide they want to buy a share or sell it?
Well, it usually comes down to a few common reasons. The first, and maybe the most obvious, is the company's performance. You know, are they making more money? Did they just launch a super popular new product? Good stuff like that makes more people want to buy. Then there's just general news and what people expect to happen. Positive headlines about the company or its industry can get people excited. Negative news can make them nervous and want to sell. And finally, there's just the overall mood of the market. Sometimes investors as a whole are just feeling really optimistic. We call that a bull market, and they tend to buy. Other times, they're feeling pretty pessimistic, a bear market, and they're more likely to sell.
And this is a really, really important idea to grasp. Whether we're talking about performance, news, or mood, at the end of the day, it's all just different kinds of information. And understanding that really changes how you look at those price swings.
Here's the key takeaway. A share's price isn't random. It's more like a live snapshot. It captures all the information, all the hopes, all the fears that investors have about a company at that very second. It's the market's collective opinion, all boiled down into one single number.
So, next time you see a price moving up or down, remember what you're actually seeing. You're not watching a casino game. You're watching thousands of people reacting to new information in real time. The market is constantly processing everything. Company reports, news headlines, you name it. And the price is just adjusting accordingly. It's a system based on information, not on luck.
Hey,
And if you're following along with this series and finding it helpful, we'd love it if you'd consider subscribing to NeuralTarot. That way you can keep learning with us step by step.
So that naturally leads to the next question, right? If that's how prices work, then what's the difference between someone who invests for the long term and someone who's just trading for the short term? That's a great question, and it's exactly what we're going to break down in the next explainer. Hope to see you there.